As always, I'll keep the introduction rather brief so that we can give as much time as we can to Andy. Somebody in the crowd just stopped me on the way here. You know, this guy is a legend in this field, and so it's great to have Andy here with us. Andy Paul has been actively engaged in private equity and venture capital investing for over 20 years, primarily in the healthcare industry. In addition to founding and chairing the board of Enhanced Capital, he's chairman of its investment committee and managing general partner of Enhanced Equity Fund, a $225 million fund focused on lower middle market companies. Paul is also managing director of Soper's Capital Associates, which invests in emerging companies in healthcare and technology. Born and raised in Bronxville, Paul is very involved in the community. He has served on the board of directors of Lawrence Hospital and as a deacon of the Reformed Church of Bronxville. Through the Mount Vernon Educational Foundation, he recently spearheaded fundraising to save school sports, and many of you, I'm sure, were familiar with reading about that recently. Paul is also co-chairman of Cancer Research Institute and a trustee of Cornell University. He's a graduate of Cornell and of Harvard Business School. We are pleased to have Andy with us this morning.
Well, thank you very much. It's a pleasure to be here, and it's nice to see so many friends amongst all of you out there. When VG asked me to come and speak about healthcare, I was trying to think about what aspects of that would be most interesting for all of you. And I figure I have to start with some of the parameters of healthcare in terms of that as a business, and then also maybe talk about reform, because that's in the newspaper every day. And then I also thought I'd spend a little time talking about private equity in healthcare, and that's where I've spent my last 25 years investing, and some of the things that we do and how we go about our business of investing in small companies and trying to make them large companies. Healthcare is really important to all of us, and you think about it all the time, generally in how it relates to your family, but also the business of healthcare is really a large, very complex, and ever-changing industry. And we'll hopefully get a little bit of that reflected today. So just a little bit on my background. VG did a nice job. I've spent 25 years in the private equity industry, focusing on healthcare investing for the most part. I joined a small firm at the time, Welsh, Carson, Anderson, and Stowe, in 1984. We had $146 million under management. Today, that's over $20 billion. And they're the largest investor in healthcare services in the country. And while there, I co-managed that and did 37 equity and subordinated debt investments in 25 companies. I retired in 2000, and it wasn't more than 60 days when somebody called me with a really interesting healthcare investment. And I said, gee, it's like money on the street, just bend over, pick it up. So I decided to do that deal, and one thing led to another, and now, nearly 9 years later, I've found myself more than full-time employed. I've got 3 funds that I have started and I'm the principal of. One is a private equity fund called Enhanced Equity Fund, and we have 3 large investors that have given us the $225 million. I have a venture capital firm that focuses on healthcare and other things, technology and other types of businesses, and that's a geographic-specific kind of venture fund. And then I started a family office back in 2000, and we have 20 investments in that. And all told, we have about 25 people in different offices around the country looking for healthcare services and other types of investments. And over that period of time, 25 years, in all of these different chapters, I've been able to return at the portfolio level a 50% compounded return for 25 years. So we've been lucky for a long time. All right, here's a quote from a Democratic president, and I want somebody to tell me who that is. It's very topical. Anybody have a guess who that is?
FDR.
Not FDR. Who?
Harry Truman.
Truman, that's exactly right. That's a quote from Truman, 1945, in a congressional speech. And I think it points to how difficult this healthcare problem is and how long it's been going on for. And, it's very, very hard to change. There's lots and lots of constituents that have very strong, powerful lobbies. And to get anything done is really, really complex. And we'll talk a little bit more about healthcare reform in a minute. So this is sort of a broad picture of the healthcare industry. There's sort of three major sectors. There's a healthcare services sector, which probably makes up roughly 70% of the dollars spent. The dollars in this healthcare industry are about $2.6 trillion. Then you have the life sciences side, which is pharmaceuticals and biotech and things like that. And then the medical product side, and that's stents or knee replacement stuff or imaging pieces of equipment, et cetera. So where we spend our time is healthcare services, and that's in managed care, in hospitals, in surgery centers, in home care, and all those other areas. So that's the aspect of healthcare that I find the most interesting. So healthcare is the largest sector in the U.S., and if you look at the dollars, we're at 2.6, just about 2.6 trillion of GDP, and it's 17% of GDP, and it grows at 7%. And that's really just astounding when you think about where we were back in 1960 at 28 billion to where we are today. And then you look out another 10 years or so, and we're talking about $4.3 trillion, and it'll be 20% of GDP practically. The nice thing about healthcare as an investment vehicle is the industry is it always grows. So you never talk about the ups and downs of healthcare. You only talk about the rate of growth. So growth is going to be anywhere from sort of 2% in a really terrible year to maybe 10 or 12% in a really good year. And if you're looking at an industry to invest in over the last nearly 50 years, you can't think of one that has a chart that looks like that. And so that's a good place to be. The other thing is the industry's always been recognized on Wall Street as a good place to invest. And if you look at, over the last 12 months, going through the end of April, how have the industry groups done? The public stocks, financial services have gotten crushed with the B of A and Citibank. And then, you go all the way to the right, and the industry that's been hit the least is the one of healthcare. And it's because of the stable nature, the lack of cyclical ups and downs in the business. And what are some of the things that drive that? I mean, it's got a couple of big trends. The big one is age. And if you look at the number of people that are turning Medicare eligible, which is basically 65 and older, you can see that in 2010 we're going to have 40 million people. There's about 300 million people in the U.S., so that's a very large piece, and it's growing very quickly. And if you look at what's going to happen over the next 8 years versus what happened on the 8 years previous to that, there's a lot more times, 3 times more Americans going to turn Medicare eligible. And the older you are, the more healthcare services you need. And that's just sadly the way it is. So if you look at the dollars, where did the dollars come from and where do they go? Private insurance represents 35% of the dollars. Medicare is 19%. Out-of-pocket's 12%. That's a piece that's going to get bigger and bigger. Right? My guess is if you go back 10 or 15 years, the out-of-pocket would have been half that. But as corporations are shifting more onto the people that work for them, and Medicare is pushing more onto the people that they cover, out-of-pocket's a big problem, and it's only going to get bigger. And where's the dollars spent? So the dollars are spent in hospital care at 31%, with physicians and clinical services at 21%, and you can see the others. And the federal government makes up about a third of the dollars spent in healthcare. So they have a big say. If you look at the non-Medicare healthcare population, that's sort of the 65 and under, most people get their healthcare from their employer. But the thing that's really driving healthcare reform this time around is this uninsured percentage of 18%. That's around 45 million Americans without insurance. And if you look at sort of the next bucket, which is a whole other group that are underinsured, where they might have some basic elements, they might have some catastrophic insurance, they don't have enough full insurance, and those are causing huge problems within the healthcare world. So when we look at why do we want to invest in healthcare, there's a couple of things that really make a lot of sense to us. So one is the aging population. And there's just nothing that's going to change that. People are getting older. There's a huge baby boomer bulge coming into the Medicare age. So that's going to drive services, no question about it. And then there's technology advances. These technology advances are extending the life of people. So go back 10 or 20 years, people maybe died 5 years earlier than they are today. And going out another 5, 10, 15 years, they'll extend life on the average another probably 5 years. So as they get older, more services are needed. Technology advances are very expensive. You got. I was just at a healthcare conference, and there's a new cancer treatment protocol beyond radiation therapy, where the cost of putting in one of those systems is $150 million. There's only 3 or 4 operational in the United States today, but a number of people are trying to put these into their hospital systems. And at $150 million per center, you can see how that would add up very, very quickly. And that's kind of the arms race that's going on. Once a hospital has that, the one down the street needs to have that, and that kind of thinking has led to a lot of expenditures. Another trend that's happening is people are taking more ownership in their health care and their diseases. So what happens is they find out they have something, and then they want to learn more about it. They want to make sure they're getting the state-of-the-art treatment. So they go on the internet and they learn about it, and then they push very aggressively with their doctors and others to make sure that they're getting the state-of-the-art treatment. And that tends to be very expensive. What we like, as we talked about earlier, it's non-cyclical, and it consistently outperforms the S&P 500. So if you can build a company in healthcare services that gets big enough to be a candidate for a public offering, you've got a very receptive audience of a group of investors that will pay you a very handsome price for it. So what we've done over the years is start with smaller companies, build them up through acquisition and growth, de novo growth, and get it to a size that's big enough to either go public or to sell to a large strategic. But the other thing that's really attractive about this industry is it's really a bunch of middle market businesses. Healthcare is made up of lots and lots of sectors, as we saw in that earlier chart. But even within those sectors, there are lots of subsectors, and those subsectors are quite large. So you look at just home care. You've got a home nursing component that's really large. You've got home oxygen, people that need oxygen if they have a respiratory disease. They have hospice for people that are in the later stages of life. They have home infusion for people that need drugs at home. They have all kinds of billing companies that help those companies bill. They have all kinds of IT companies that help those companies manage their business. So just in the one sector of healthcare, which is home care, there's probably 15,000 companies. There's over 7,000 agencies just in the home nursing side alone. So it's a very big business and easy to do acquisitions, and that's one of the things we really like. It's fragmented, as I just described, and lots of sectors. And the other thing that's, I think, made those that are committed to the industry do well is that it's very complex and it's very regulated. And so what that does is it keeps out the average investor. It keeps out somebody that doesn't really commit themselves to knowing healthcare, because it's easy to get burned. You could go into an industry, it's about to have reimbursement change, and you don't see that coming, and you could get crushed. And or they go in and they don't understand that what they're doing is not legal or whatever, and it's a compliance problem, and that's going to cause issues. So given kind of the history and how complex it is, lots of people just say, there's 80% of the economy that's not healthcare. I'm going to spend my energy there, and that leaves this 20% for us. So we follow a couple of basic philosophies that we really try to stick to. They all sound kind of simple, but it's really all in the execution of how you do these things. We really are very, very focused. So right now, we invest about 80% of our dollars in healthcare services, and we have 20% we invest in information services, both industries that I've invested in for the last 25 years. We don't do retail. We don't do lots of other things that could be very good businesses. We just don't understand them, and we really know a lot about this. And when you're focused in a single industry, it gives you a lot of informational advantages. When I call up and want to evaluate a new business or a new company or a new executive, I have people that I've worked with for the last 20, 25 years that can give me the straight story. Where I can't tell you how many times I've heard, Andy, I'll tell you this because I know you and trust you, but I won't tell anybody else. This guy's not a good guy. He's worked for us. He's a bad guy. The party line is he's terrific or he's okay, but I'm just telling you because I know you and I know our paths will cross again. This is not a guy you can back. And that there's no better piece of information than that. And what we really try to do is always have as much information on the industry, the reimbursement changes, and on the people that we're going to be backing. A lot of people in the last 3 or 4 years have gotten really carried away with what was happening with the stock markets and buying companies. The private equity industry probably bought things on average of 10 times cash flow in the last 3 or 4 years. We, in the last 3 or 4 years, bought things at an average of 5 times cash flow. You say, well, how did we do it at half the price of what everybody else was? We had to stay at smaller companies, and we had to work really hard to find exactly the kind of company that we could work our way into at a much lower price. The other big mistake the other private equity firms made over the last 3 or 4 years is they put very aggressive capital structures on these companies. So when they bought something for 10 times, they might have borrowed 6 times against that cash flow. Because we bought something at 5 times, we would put about 2 times against that cash flow. And if you look at our portfolio today, we have 1.7 times earnings against a debt to earnings in our companies versus an industry average is probably 5 or 6. And many businesses today have been revalued at 5 or 6. So you can imagine if you've got 6 times debt and the business is worth 6 times, all the equity you put in is now worthless. And that's what's happened to private equity. That's why most of the big private equity firms are running losses of 30, 40, 50% over the last couple of years. The other thing is it's really all about management at the end of the day. You hear that all the time, and it's really so true. Some of the best companies I've ever done have been with outstanding management that needed so little of our help. One company, Lincare, that I had started and was chairman of, it had the best single team I ever saw. And they, at every board meeting, they list all the issues, what their game plan was for it. And in 5 years of being with that company, I never once thought that they weren't exactly on track. And that company, we bought the equity of that company for $15 million, and that had a market value of over $4 billion a couple years ago. So it was it's a huge home run. We had a multi-100% IRR on that deal, and it's just a great company. So if you get the management right, then almost everything else falls into place. One thing that we do that's a little bit different than some others is we always want to have an operating partner that's an expert in the industry that we're investing in alongside us. And what we do there is, even though, let's say, take home care again, it's an area I've invested in probably in 4 or 5 companies over 25 years, one that I feel I know a fair amount about. But when we started our new home care company, we went out and found the chairman and CEO of that Lincare company I was just describing to go in and be an operating partner here. And that means he'll sit on the board, he invested his own capital, he's working with us to bring in the right management team, and he's working with us to build the company. So here's a guy that just has lived home care for 20 years and knows it so much better than I would, even though I've been an investor in it for 25 years. And that combination of our financial expertise and strategic expertise, along with his operational expertise and an excellent management team, is really, I think, what makes us successful most of the time. And then once we do close on a business, we spend a lot of time actually building it. And we obsess on the details of how do you grow a business and how do you get the most operational efficiency out of the company. And the way we do that is we do a lot in the acquisitions of other businesses. So I'll actually get to that in a second. Okay, so here's just an example of a company kind of talking about some of the things we've done. So what we liked about healthcare services companies is there's low capital expenditure requirements typically in many of these services businesses, and they throw off a lot of free cash flow. So we invested in a company that's called Correctional Healthcare, and what they do is they take care of the healthcare needs of prisoners. And one of the things that many of you will not know is they're the only group in America with a constitutional right to health care. Everybody else, it's a privilege to have health care, or you have to pay for health care. But there's been Supreme Court cases that say prisoners are entitled to health care services, and so they get a standard level of care. So the nice thing about this business is we don't have a lot of AR, accounts receivable, because the state pays us in advance. So we know that at the start of any month, we get our money in advance for these prisoners. And we don't have a lot of capital and things that we have to use. So when you look at the cash that's generated from this business, there's a lot of cash. And what we like is we can be a low-cost provider with a strong value proposition for all constituents. You can imagine the sheriffs in all these counties and cities really not being healthcare experts. They weren't put in that job to be an expert on healthcare. They were put in that job hopefully for law enforcement skills. And so they look for ways to be more efficient. And that's one of the things that we've done. And it's a fragmented sector, and it's really quite large, $7 billion. And what's happening is this industry is becoming, like a lot of things, more outsourced. As more and more counties realize there's a better way to do this sort of thing, they do it through outsourcing, and that's where we get involved. And we can earn a nice 10% profit margin, which is 24% pre-corporate. And as we add more and more revenues down the line, we're able to increase that EBITDA percentage, because the marginal cost to add a new contract is really quite low. And we think we're pretty safe, and that the number of incarcerations are going to continue to rise, which is the good news and the bad news, right? A big part of how we build value is, as I said, acquisitions. And so what we do is we go out, and this is just a list of our companies that have gone out in the last couple of years and made some acquisitions. And the only point of this slide is that we are disciplined in what we buy things for. And in this case, we on average, bought companies at 4.6 times. And then within the first year, we made improvements on those acquisitions to make it worth 3.8 times. And if you're able to buy good growing businesses at 3.8 times cash flow, when we can take them public at 10 or 12 times cash flow, when markets are good, that's just a great arbitrage spread, and that's really how we make a lot of money. So we talked about management. What's key about management? I just want to give you a couple of examples of what we do. So we convince people that are way overqualified to come into our small little companies. And why do they want to do that? Because they know we have a track record of building successful companies, because they can be the CEO and in charge, and we'll leave them alone, because they will get a very attractive equity package, and they can make a lot of money. And many of these people have worked with me before, and they know that it's kind of fun, and we make a point of doing everything in a way that's very professional and very supportive. So Guardian, as an example, Steve Boyd was running the operations of Lincare, which was $1.6 billion in revenue. And then he was president of another company of ours that we sold and made a lot of money in Magella. And we convinced him to come into, at the time, probably a $20 million home care company. He's such a good operator. He's been there about 2 years now. We now have the leading margins in the industry after only 2 years. Many of these companies have been in this business for decades. But Steve is such a good operator that he's able to drive value and drive operational efficiency, really unlike almost anybody else that I've been associated with. Tim Booth, another very proven guy. He was running for McKesson, a huge leader in a healthcare packaging business. He was running a $780 million business, and we convinced him to come over to run our $20 million business, and that we would support him with money for acquisitions and growth. And we're on that path, and we're off doing really well. Both John Morris and Doug Getz have worked for me before, run big successful companies that we made good money with, and that continues to be the case. And then I talked about these operating partners, and this is just some backgrounds on some of the operating partners. Jim Kelly, I mentioned, was the home care guy from Lincare, one of the all-time best I've ever seen. Don Steen. Don Steen's a legend in healthcare services. He's built 3 multi-billion-dollar companies. We backed him in one of those, a company called U.S. Surgical, a big surgical care company. He founded Medical Care International, the leading medical surgery center company, the first one out there, sold it for several $1 billion. And then he just sold another company for Welsh Carson for $2 billion in the lab space. Just an outstanding executive, and he decided to put some money into this company, which is an urgent care company, and to really be a mentor to the management team. A lot of these guys are all these guys have been very successful financially, but they like to give back, and so they have fun working with these management teams and mentoring them. David Stevens was a guy I backed who started a company in the specialty pharmacy space. We bought 90% of that business for $25 million, and that business got sold for $2.7 billion to Medco about a year and a half ago. And these are the quality of the people that we like to be associating with our companies. And if you have this quality of people, you're going to generally have good things come. And this is just very quickly summarizing what we do. We find a company and we make sure we get the right management team. In almost every company we've bought in our private equity fund, we've changed the CEO, the CFO, and a number of other folks. The systems are never quite good. There's usually a QuickBooks. We have to put in a whole new accounting system. The processes, whether it's purchasing or sales process or whatever, is usually not up to snuff, and we have to upgrade those. That foundation building takes a year. We then move to phase 2, where we've got a good management team and a solid base, but we need critical mass. We'll then make a transforming acquisition, and that will sort of double the size of the company typically. Once we get that integrated, we now have a relatively big profitable company, and now we're ready for phase 3. And phase 3 is where we really can generate the returns, because now we can do several acquisitions, 3-4 acquisitions a year, and we're buying them at sort of 5 times and making them sort of efficient at 4 times. And after you do enough of those, you really end up with a fairly decent-sized company with good profitability, and it's ready to be sold or taken public. Excuse me. So how have we done? So if you look at what we've done here, our initial investment in our latest fund was $72 million. This is revenues. Revenues of $72 million. And today, if you look at a pro forma, what we had over the annualized last 3 months of 2008 was $226 million. So we had 214% growth in our revenues, and in our profitability, we had 187% growth. And think back at how tough last year was on almost every company in every industry. Very few people had the growth. If you look at our overall industry, our overall companies in our portfolio, year over year through first quarter, our profits were up 51%. And think of how many companies you know that had 51% earnings growth in the last 12 months. All right, let's turn our attention to reform. And there's a lot of aspects to this. We're waiting on a number of people to weigh in to kind of come up with a finalized version that's going to be fought about. So right now we're in the very early stages, and it's unclear where it's going. So I'll just give you some facts, and hopefully in 60 or 90 days we'll have a better idea where this is going. So in February, the president signed into law this economic package that was trying to get the economy going again. And in that, there was $100 billion for healthcare initiatives. $20 billion of it was for electronic health records. They're trying to get the industry to be much more electronic and much more efficient. And that would be a great objective. But where we stand today, there's less than 4% of the hospitals and the physicians that are using electronic health records. So 4%, trying to get to 100%, took us forever to get to 4%. So you can imagine that that's not going to be an easy problem to solve. But they're putting a fair amount of money behind it to try and encourage doctors and hospitals to do that. And then the other thing they did was they put $86 billion to fund Medicaid. And what happened there is the state budgets were all getting crushed over the last year. Property taxes were going down, sales taxes were going down. And there was a big gap in what was going to be funded for Medicaid. And Medicaid is a program that is partly funded by the government, by the federal government, partly funded by the state government. Some poor states like Mississippi, 80 cents of the dollar comes from the federal government. Other states that are wealthier, it's closer to 50-50. But by funding $86 billion, it fixed a huge budget hole in many of the state budgets. It also was a back-end way to get more coverage to some very needy people. And what was happening was when Medicaid gets squeezed, they have to drop eligibility. So if, let's say, they got 1 million people in their state that are in Medicaid, if they have fewer dollars, the way they typically solve that problem is they'll change the eligibility, they'll draw the line higher, and only 800,000 people will qualify. Now, those other 200,000 people are still extremely destitute and in need of health care, but there's just no dollars to cover them. And what they didn't want to have happen was that. And so by giving this extra money to Medicaid, it allowed it to stay at least at the million and maybe even to go to 1.1 million. So I think a few more people were covered with this extra dollars. All right, so where are we today? So in March, the president talked about how he was going to cover everybody, and this was his initial proposal for health care reform. And it was going to be $634 billion, half paid by increased taxes and half paid by cuts to Medicare expenditures. And the cuts were going to come in pretty much across the board, but a couple areas we're going to hit particularly hard. And one is Medicare Advantage. So that's HMOs for the seniors. And it's been a pretty successful program. The critics argue that they've had to pay more for somebody in Medicare than if they'd been in just the straight fee-for-service program. So take California. California is a very expensive state for health care in Medicare. So let's say the average population of Medicare is spending $1,000. It's costing 18% more in California to cover that population in managed care than it is if they just went through the fee-for-service. And so what the government's trying to do is to say, look, that's crazy. If we're going to be managing the care, we shouldn't be paying more to manage the care. So we're going to bring everybody down to just what the fee-for-service level is in that state. And that's a big number. So that's $177 billion over 10 years. They're talking about reducing payments to home care. They're talking about bundling post-acute payments. Right now, a bunch of these sectors will treat somebody for a period of time and then shift them to somebody else, and then that person gets to treat them for a period of time, and maybe they shift them to somebody else. So the government is really paying maybe more than they should if you said, all right, you cover them for that full episode, that 6-month recovery period, and instead of the 3 of you doing that, I'm just going to pay one person, and they have to coordinate how to get that done. And there's some money to be saved there. And then in the spring of 2009, there's been 3 papers put together by the Senate Finance Committee covering changes to the delivery system, ways to expand coverage, and how to finance it. And those are all being sort of talked about now. And this will come together, hopefully, in the next few months. But there's some, obviously, big challenges. If you look at the cost affordability issue, if you look back in 1999, the average insurance premium for worker contribution for family coverage was $5,700. And today, it's $12,600. And that's really one of the huge fundamental problems in American business. And it doesn't take far, in terms of looking at the auto industry and the help that healthcare premiums have contributed to the problems that they're having. I mean, I've heard numbers that every car has a $1,200 to $1,500 payment because of the expensive health insurance of the workers there. And in a competitive industry, $1,500 is a big difference. And this is a trend that's continuing, so it's not like we're going to have it solved. And this is really one of the things that they've got to figure out how to stop, because it's 17% of GDP. It's going to be 20% before you know it, and it's going to be beyond that unless something big happens. And the problem is the 2 changes that have to happen to really make health care right are extraordinarily expensive, probably another $1 trillion. So to take on these 45 million Americans that do not have health coverage, and the other group that has only partial health coverage is a huge number. 25 million are the ones that are underinsured. The thing that most people don't understand about these people that are uninsured is these are working Americans. These are not Medicaid or out of jobs. These are not homeless people. 8 out of 10 are people that work at a McDonald's or work at a Walmart, or just do not get insurance with what they're doing, and they're working very hard to try to make it work for their families. And I think that's why it's politically very important to try to get something worked out this time. And I don't think anybody disagrees with the concept that we should have universal health, whatever that means. People should have the right to health care. The problem is, how do you pay for it? And that's where it all breaks down. And if you look at kind of the quality of the U.S. health system, we rank last out of 19 industrial countries in unnecessary deaths and 29 out of 37 for infant mortality. I mean, that's kind of crazy when you think about all the hospitals and all the outstanding doctors and everything else that we have here. And we have more care. Does not necessarily mean better care. And we have just a lot of problems with the quality, and the costs continue to go way up. So it's a big, vexing problem, and not obvious where it's going. So these are some of the things that people have been kicking around. Will there be a single-payer system like Canada or Britain? And I don't think that's going to happen. It's just not sort of the American way. I do think there may be the government playing a role in healthcare, maybe having a plan of last resort for people that can't get an insurance plan, from an Aetna or a United or whatever. That's one of the big debates that's going on now. But that could change. I mean, at some point, if something doesn't get done here, there's going to be a need to get something done at some point, and all bets are off if it doesn't happen now. And then another thing they're talking about is should there be an individual mandate or an employer mandate, a pay-to-play, so to speak. So an individual mandate is in order to work, you got to have health care coverage, and that puts a lot of burden on the lower 20% of the working Americans. And then in the employer mandate, what stopped this one is you either have to offer health insurance or you got to pay into a fund that will then pay for health insurance. But a lot of small businesses don't feel they can afford to pay health insurance and still keep above water. One of the questions is, will you lose your existing coverage? And I don't think anybody's talking about that. So I think that, if you've got a United plan now or you've got a retirement plan or whatever, you're probably going to be just fine with what you have. There's absolutely going to be a lot of reimbursement pressure on the providers. It just has to be. If you're going to insure 45 million more people, there's going to be a lot more procedures going through the system. There should be kind of a volume discount that happens across the board, and that will happen. Will there be a lot more managed care? As a student of healthcare, and I go around and I see a lot of different models and what works and what doesn't work, there really is nothing that works other than managed care in terms of really driving down costs. When you go down to South Florida, which is a very, very competitive market, or out to California, you can see these medical groups that have become really expert at managing the care of their members. They focus on wellness. They focus on getting things early. And they make sure that the formulary for the drugs you're taking is going to be a lot of generics. And if you're out on your own and the doctor gives you a prescription for $1,000 for a drug that you pay maybe $50 for, you don't think too much about that. But they think a lot about that if they're managing your care, because they can get that same thing for probably $30 in a generic. And so that kind of management is needed, and so we'll see what happens. And then will there be a tax on healthcare benefits? Because a lot of people argue, look, if I work for IBM and I've got a really blue chip package of health benefits, isn't that really compensation? So should there be a relatively low base that everybody gets, and that's kind of for free, but if you're going to get something that includes all kinds of life insurance and any doctor, any time, any price, you should pay some tax on that. And that's a huge bucket. If they went in that direction, there's a huge bucket of dollars there that could pay for this 45 million uninsured. Every major employer and every union would go crazy on this kind of plan. But again, somebody's going to go crazy on something, because otherwise it's not going to work. And then the last thing is, should there be a lifestyle tax? Should there be on alcohol or Pepsi or Coke or candy or whatever, things that will help fund? Because if we got to find $1 trillion, it's got to come with some pain. And one of the things I didn't mention that's kind of a game, an accounting game that the government plays. Is they have they want to come up with a balanced budget on healthcare. So anytime they add a new service, they got to find savings. And the way that they've kind of gotten about 50 to 100 billion dollars of savings is by claiming that there's going to be a 20% cut on doctor salaries. And there's just no way that doctors are going to put up with a 20% cut on doctor salaries across the board. And that's in every year. And every year there's a legislative change that happens usually December 31st that allows the doctors to get a 1% increase or a no increase and not have to suffer this cut. But January 1st, there's an automatic, in the law, 20% cut that hits physicians unless it's changed by Congress. And to fix that problem is a $300 billion problem. And that has to be fixed as well. So it's big. These numbers are big. All right, so what are the key trends? Well, there's going to be lots of winners and lots of losers in healthcare reform. And that's good for an investor like ourselves. When we look out and see that there's going to be things that are going to create opportunity, we're hopefully smart enough, being experts in this business, to find where the opportunities are going to be and to get in there early, to get in on something that's earlier. One of the things that we've been looking at, we haven't done it yet, is when the government announced this plan where they were going to take a lot of money out of Medicare Advantage, you saw some very, very profitable HMOs that are taking care of older people. Prices cut 70, 80%. These businesses are very good, very profitable, and are better than an 80% cut. So the pendulum had swung too far. So we've been looking at maybe investing in that sector carefully and being in a position when the cuts happen to be with a good company that we hadn't overpaid for and to grow with it. So we haven't done it yet, but that's one of the things we're looking at because the markets tend to go up and down, and a lot of times they get out of sync with what the real value is. What you're going to have to do for sure is focus on controlling costs and values. One of the things that people complain about is that you don't get good quality necessarily for paying for a lot of money for the services offered. I mean, there's countless cases where you go into a hospital and you see people go into a hospital and they don't get good care, or they get a staph infection while they're there, and then they got to come back and it's twice as expensive and that sort of thing. And the government doesn't want to pay for that. They're coming up with a concept of avoidable costs. So if there was something that was avoidable, if what happened was really your fault, if you did a surgery on the person's left knee and they were supposed to have it on their right knee, they're not going to pay for that kind of stuff. And in the old days, they would pay based on procedures. So there's going to be a rise in value and a way to try to measure that. And then there's going to be a huge focus on preventative care and disease monitoring. Like all businesses, there's an 80-20 rule. The 20% of the population covers 80% of the costs. And, in the last 6 months of life, almost 75% of the dollars are spent. The trouble is you don't always know when the last 6 months of life are. But in some cases you do. I mean, you hear all the time somebody with terminal cancer that, they decide to do a major surgery that, on their back or on their leg or something to give them 2 or 3 more months of life. I mean, most countries don't allow that to happen. And if you wanted to do that with your own dollars, I don't think anybody should argue that. But should the U.S. government be paying $100,000 for a surgery to extend your life if you're 85 by 2 months? I mean, those are hard ethical questions, and nobody really wants to address those. But those are the kinds of questions that are going to have to get addressed. And in the UK, they've made those assessments. They say, look, at the end of life, we're not doing anything heroic, and that's just accepted, and that's just the way it is. And if you have the money yourself to do it, fine. If you don't, then that's it. And then the hospitals are really not a very good place to have a lot of services done from a cost point of view. There's kind of 2 things that go on there. Number one is for many services offered by a hospital and offered across the street from the hospital will get a much higher billing rate because they have all this overhead that they have to cover. So if you had a lab test done at a hospital or an MRI done at a hospital and done across the street, In many cases, they may pay twice as much at the hospital for the exact same service across the street. You could argue that that doesn't make a lot of sense. The trouble is, if you take all these procedures away from the hospital and you leave them just for what they were kind of initially made for, which is, very emergency care and very detailed surgeries and things, the hospital can't survive. And so we've got this really fundamental problem in healthcare about having at the center of every community and at the center of all the healthcare delivery in this country a very inefficient, high-cost model. And we own, one of the companies we own is an urgent care company. And if you look at a hospital's emergency room, there's probably 50 or 60% of the people that walk in that door really shouldn't be there. They're going in for a sore throat or an ear infection, or they've got a scratch that needs two sutures. These kinds of things really should be done in a much lower cost setting. It would make the emergency room experience for those that really have an emergency much more effective and fast and pleasant if these people that didn't have real emergencies could be pulled out. And that kind of trend of migration from acute care to lower cost setting is going to happen. And it's been happening for the last 25 years. Surgery centers have set up to pull surgeries away from hospitals. Imaging centers have been set up to pull imaging away from hospitals. And that's going to continue. And eventually we're going to have this issue of how do we support a hospital that is not efficient, but is really necessary when you have something that's very acute. And then because there's going to be so much volume increase when you start having the fully insured, have people that were uninsured now fully insured and the underinsured now fully insured, they're going to have more things done. They're going to buy more drugs. They're going to have more surgeries. They're going to have things done to them that are going to increase the volume in the system. And that's going to put a lot of stress and strain, if you start to see that happen as well. There should be, some good news for a lot of providers that they'll see increased volume. But not, if Lawrence Hospital saw another 50 patients a day, it might break the system. So, there's issues around too much demand coming in all at one time. All right, well, that's kind of what I had prepared. Any questions?
Those of you who need to leave to catch a train, please leave quietly. Welcome to stay and continue on for a while.
Actually, I said him first. You're second.
Is there going to be an integration between long-term care and regular health care?
Nursing home type care?
Long-term care.
I think of long-term care as nursing homes. Are we using the same definition?
Private home too, and you pay for either, both of them. And I was just wondering if the government is ever going to get involved.
Well, Medicaid is the largest supplier of funds to the nursing home industry. They represent probably 80% of the dollars. So most people, either are destitute by the time they get to a nursing home, or they spend away or give their money away and then go into a nursing home. And the government, usually state and federal together, Medicaid, picks up those costs. And so I don't see that model probably changing much.
I have a question about reimbursement. When you get the forms back, it looks as though the insurance companies really don't pay that large a percentage of what the provider is charging. And I wondered whether that was a break, any kind of a significant factor on costs, or whether the provider was just jacking up the price to allow for that percentage that's going to be taken off. And I guess the other question is, when the insurance company does decide to give that small reimbursement, is that kind of arbitrary, or is it based on some kind of a college of people getting together deciding what the prices should be?
Yeah, so the first one, it's really the latter. Let me address the second question first. The second question is that there's a rating agency that sort of goes around and says what the typical cost of a surgery or a hospital day should cost. The company that's been doing that is a company called Ingenix. Ingenix is owned by United Healthcare, one of the largest insurers in the country. Of course, insurers will pay, based on what the percentage of that cost is. So let's say it's, $1,000 for a procedure that Ingenix says. Well, if it's really $1,100, but they say it's $1,000, they've saved some money for their insurance friends. And as a matter of fact, Ingenix was just hit with a lawsuit and settled, paying hundreds of millions of dollars to the federal government for, in essence, keeping the cost, the true cost down in how they evaluated what the cost of a service is. The other question was on. Give me the other question again.
Well, the other was really whether by taking a much lower cut.
Yes, okay.
Whether that does serve as some kind of a break on these services. I mean, over long term.
It's no break at all.
Whether there's just an allowance made anyway by the provider, so that they'll try to.
Yeah, the way a lot of people pay is a percentage of charges. So the higher you can jack up the charges, the higher that percentage. So let's say some insurance company agrees to pay hospital 60% of charges. So it's in the hospital's best interest to get charges up as high as they possibly can because they're going to get 60% of that number. And so there's a arm wrestle all the time between the insurers and the providers on what the percentages should be, and so the incentive is to jack it up. So it looks like it's maybe a discount to to you, but it really is no discount.
Well, let's talk about the progress of medical care. Is any consideration being given to the medical legal issues? Malpractice and so on?
Yeah, so malpractice has been a huge problem in this industry, and the number of OB/GYN doctors that are practicing now and actually delivering babies is down probably 30 or 40% because of the cost of medical malpractice. I think, I'm a little stale on my number, but I think in this area, an OB/GYN needs to pay about $120,000 of insurance to deliver babies. So think, how many babies they have to deliver just to cover the cost of their insurance. And so somebody that doesn't have a super busy practice is going to say, that's not worth it to me, so I'm not going to deliver babies anymore. And it's obviously not good to have experienced doctors leaving the system because of that. And that happens in a lot of different fields as well.
It's even a factor in starting your practice.
Yes.
If you had $100,000 for insurance before you make your first cut of that.
Right.
It's kind of hard to do.
Hard to do. And actually that's leading to one of the big trends for physicians is almost all the physicians coming out of medical school are going to work for somebody. They're going to work for a hospital, they're going to work for a larger physician practice already established. Very rarely do you find a physician that says, I'm going to go into business on my own because of all these costs, these medical malpractice costs, and the headaches with dealing with insurance. I mean, trying to get paid is crazy, and it's just not worth it to so many people. John?
Andy, I'm still mystified. We're talking about leveling off healthcare expenses at 17% of GDP. At the same time, we're adding 45 million uninsured, more insurance of 25 million. Where are the big savings in the whole system? What are the major savings?
The major savings have got to be in efficiency and in sort of wellness. I mean, things that are sort of squishy. Like, if I take care of, if I make sure that my obese workers, lose weight, go to a gym, talk to somebody, a doctor or a nurse in our factory, and I can get them from having to go need surgery or go have diabetes or something. That's big, but how do you put your arms around that? So it's a whole sea shift of things, and better coordination is definitely going to make a difference. I mean, I just had, I've had a small issue with my back, nothing serious, but I've had like 3 or 4 MRIs. I've had a bunch of X-rays. I mean, the expenditures to kind of figure out what's going on, and nobody wants to look at the MRI from the doctor that looked at it before. He goes, well, my guy does a better job, and he looks at it from an angle that is really important to see, and I don't think the other guy did, and all that sort of stuff just adds up costs.
So, from an investment perspective, lots of mega trends you showed early on that suggest there will be a lot of growth in healthcare, the need for healthcare, which is usually good from an investment perspective. But it would seem most people in this room probably own large healthcare companies, drug companies, managed care companies, maybe hospitals, big equipment companies. It would just seem to me that they're really going to be up against it in terms of their margins. Given there's not enough money in the system, given the government's going to get involved, decrease, reimbursement rates for drugs and services and everything. But net, do you think it's going to just be hard to make money as an investor in healthcare with these large companies?
Yeah,
As opposed to the things you can focus on?
It really all depends where they set the rates on things. Right now, that's a huge unknown. So, take a drug company. If they set the rates, down 5 or 10%, but they're seeing now, 60 million people they didn't see before who can afford their drugs, that might, given that they got a 99% gross margin on their drugs, that may be more profitable for them. May not be. It really depends where the rates are. So I think right now it's very hard to figure out what's a good sector and what's not a good sector in the next 6 months. This plan has to get out, vetted, approved, and then the new rules will be in place. And once you know what the new rules are, hopefully there'll be some obvious places to go. But there's going to be a lot of reimbursement pressure, for sure.
You need to have it back next year, Lee.
Massachusetts has experimented with one form of universal health care. What are the lessons that have been learned from that experiment?
I'd say one lesson is that they greatly underestimated the cost. And so what they're starting to see now is, that the budget for whatever they thought it was going to cost, it was way low. And now the reality of very expensive new bills coming in. So I'd say that is a big challenge. And they did, I think, quite effectively get a lot more people covered, and that was a good thing. But costs have not been managed well. So I'd say that one is really very much on the fence in terms of people liking that or not liking that, depending on your perspective of coverage.
Do you see any difference if the federal government does the same thing? Is it still going to be a major?
Well, if it's the same kind of plan, the costs are going to go way up. Obviously multiplied by 50 states. So it's it's really hard to know. I really don't know. It gets down to personality. So just a little example on that. So in the Senate Finance Committee, there's 2 guys driving the bus. One is Baucus and one is Kennedy. And Kennedy has always had the dream that he wants a government insurance plan. So he wants to be able to, have, U.S. insurance owned by the federal government that will offer a plan in competition to United and Cigna and Aetna. And, that kind of big public company could have a huge price advantage over everybody else. And I think this is sort of, the Trojan horse in his mind. If you get that in, and if they're able to offer, healthcare insurance at cheaper prices, eventually everybody's going to go there, and then you'll have de facto one insurance company universal coverage. I think that's his game plan. Now that's obviously not a plan that the other insurance companies like. So they're fighting like crazy with Baucus to have a plan that doesn't include a government side-by-side plan. So it would have more universal coverage and more access and things, but they don't want that. And so that's a big fight. And who wins that fight? If Kennedy were to die soon, maybe that changes the balance of how this goes. If he's vigorous and can defend that, maybe he can push more senators to his side. That's a real-life debate going on right now. And where that comes out is going to greatly determine where healthcare reform goes. And, it's a jump ball. Vince?
Andy, it sounds like we're talking about patches and tweaks, things that currently exist. Is there any innovative or fresh thinking taking place, or any think tanks focusing on starting all over again and coming up with a system that may be better, different, unique?
I think there's a lot of think tanks, but there's just no political will behind that. There's just too many vested interests, too many dollars. One of the things, I won't mention the congressman, but he was known, he's a very, very powerful congressman. And, there was a drug, EPO drug, which is something that kind of, for people that have kidney dialysis, they take it. And, but EPO adds blood supply to the blood. And Amgen is the owner. And Amgen was a huge, huge donor to this guy. And there was lots of talk that EPO was, too highly priced, and there really should be some, price pressure on that drug. And this was one of the top 3 or 4 congressmen in the U.S. and he would not allow it to happen. He would kill any other deal or thing if anybody tried to do anything with Amgen's price. And he'd been forever a long-time supporter. And so these things get very personal. These decisions and who has the lobbying dollars, who has the ear, who's been backing that congressman for 30 years or 20 years, and these kinds of things, and what happens is literally 11:30 at night on the day it has to get done. It's a back room, and 10 guys are horse trading, and what happens, you don't ever really know. And then out comes the result.
There was the thought that it would make the end user, the patient, more conscious of the costs and by use of health savings accounts and high deductible plans. Do you see that still as something that go forward, or whether the American consumer doesn't really care whether they're paying $50 or $20 or to shop around like they do for everything else?
Well, the American population doesn't care. I mean, that's why the system's really crazy. You're spending somebody else's dollar to feel good. So lots of people spend a lot. Until you really fix that problem, you're not going to really have a fix. So that's got to be part of the solution. And I think you're seeing more push of costs onto individuals for just that reason. Because if you say, gee, it cost me $200 to go this way and buy that drug, and it cost me $4 at Walmart to get it, a generic version, hopefully more people will go $4 to Walmart. Dave?
Two things, Andy. One is there any hope for or disease management, which is, in its first iteration kind of flamed out. And I would think there would be a second wave. And secondly, unfortunately, the stock market indexes are driven by Merck and Pfizer, the big pharmaceutical stocks. Is there any index of healthcare that the publicly traded stocks that reflects the kind of ongoing stock performance that is shown in the increase in annual expenditures in healthcare?
That one, I don't follow the public stocks that closely to really check an index. There was a healthcare services index a number of investment banks used to put out. I assume they're still doing that. That would probably be the closest to it. Disease management is very interesting because the first iteration had some initial savings. And what disease management is saying, all right, we're going to pay special attention to the people that have congestive heart failure, have diabetes, have 2 or 3 other things, because this is where most of the money is. And the initial way to solve that was to have somebody on the phone. So they'd call up, I'd call Stuart. Stuart, how you doing? Have you taken your drugs this week? How you feeling? Have you been on the scale? Have you gained weight, lost weight? And just by having some interaction, you could maybe head something off before disaster happened. And that had some positive early improvements. But that's kind of petered out, and as Dave was saying. We've looked at a company recently that I think is pretty interesting in the disease management world. It's a company that goes one step further. The interaction with somebody on the phone is limited, and they're not quite as bought in. But this company actually goes one step further for these top 3 or 4% of the people that are most expensive in a plan. And they actually have a home nurse associated with that person that goes with that person to the doctors, and they develop a care plan for that person. Whenever there's an issue, that person knows the nurse, has a personal relationship, will call and say, gee, I'm not feeling so well. All right, what's happened? Well, my bed sore is open. My bed sore is not healing. So instead of going to the emergency room, which is what the person on the phone would say, because they can't see it, they can't assess what's going on, the nurse will say, I'll be right over. She'll come over, or she'll send a nurse over who can address that. And in many cases, they could fix it right there in her house and not have to send them to the emergency room and spend a lot of money. So the cost savings that this company's been able to generate on these kinds of patients is unbelievable. So the average cost of let's say the premium and then the average cost. So you look at what's the premium and then the cost to cover that person. For these really expensive people, it's about 180% of the premium. So they cost you almost double. So if you're taking $12,000 a year, they're costing you $24,000. So they were able to take that almost 2 times cost down to the premium level. So we're taking, in that example, $12,000 out of cost. They were able to bring it from $24,000 to $12,000 by really managing this patient on a one-to-one basis. And that just makes intuitive sense. If you know that somebody's a healthcare professional that knows you and is working with you and your doctor and staying on top of it, that's going to give you better care than somebody that doesn't have any of that at all. And I think we're seeing that kind of next generation of really medical home is another term we're just starting to hear.
Wouldn't that indicate that the area of being a nurse practitioner is going to grow and become more significant as a way in which we can offer medical advice and care? Because you're turning them into almost an alms money.
Yeah, I do think that that's, those kinds of people are going to be very valuable to the solution. You want to take high-cost services and push them down. So, instead of having a doctor do that, you'd much rather have somebody who's the least level of training that's necessary to do the job well. A nurse practitioner. Yeah, it is a career opportunity. I agree with that. Yes?
Given all the, I'll call them firewalls that we have on all the various state laws that we have to get through, and all the disparities, even between New Jersey, Connecticut, New York, there's a lot of disparity within the health plans and premiums and all the different programs that are offered. How do you get around that? What's the likelihood that you're going to get around that and actually get to a national program or that has some sort of consistency?
Well, it's just going to have to be mandated by law at the federal level.
But how do they do that constitutionally? Because constitutionally, it is not specifically given to the federal government, it goes to the states. How do you overcome that issue?
Well, I think it'll be a federal law. I mean, the federal law and these kind of things, I think, can trump the state. I'm not a legal expert, but
still, it's going to be a constitutional issue because you're taking away states' rights.
I don't know. I mean, maybe. I don't know enough about that to know if that's a problem.
Interstate commerce clause is very broad.
But, I mean, the earlier point you're making about the differences in states and regulation, it's unbelievable. I mean, just, New York State is probably the worst healthcare, performing state in the country. And, up in Greenwich, if you take the same surgery in Bronxville at Lawrence Hospital, and you compare it to the same surgery in Greenwich, because of all the regulations and things like that, and how backwards everything is, the Greenwich Hospital gets twice the price that we get here at Lawrence for the same surgery. And what are we, 15, 20 miles away? Comparable hospitals in size and quality. It's all, just really hard to figure out how these states come up with what they do.
This is slightly off the subject, but what's your comment on the offshore type of medical care being offered these days, where you go to Bangkok for your checkup and all that?
I'm just starting to learn more about that. It's kind of intriguing. I was just up at a Harvard Business School thing a couple of weeks ago, and the professor was talking about this doctor in India who's really changing the way heart surgery is happening in India. He's able to do a full, cabbage or, stents put in and those kinds of things. Here that might be $25,000, and he's doing it in India for about $2,500. He's truly a world-class, I mean, he's up there with the top surgeons in the world, so this is not a schlocky guy.
And he throws in a Caribbean vacation on top of it, too.
You get a vacation. But it's, so there's a lot of innovation coming into a lot of these poor countries because they have to. They can't afford health care the way it's delivered here. And some of that makes sense. I mean, some of it doesn't, but some of it does. And so I think there's going to be more efficiency coming in that way. And there could very well be ways to do that. I mean, you hear about people going to Costa Rica all the time, getting some kind of surgery done, spending a couple of days relaxing and coming home.
There's a company actually in India called Apollo that built a world-class healthcare institution that ranks as good as Columbia Presbyterian, Johns Hopkins, too.
Yeah.
That's really the next wave.
All right, so out of time?
Andy, just 1 second before we do close. For those of you who didn't fill out or stick your business card in the bowl that Capital Preservation Partners had available, you can win Yankee tickets. These are especially valuable sponsors. So they can wander around and you can get your card, fill out something, and get in the raffle for Yankee tickets if you'd like. We appreciate the sponsorships and Capital Preservation Partners. Andy, I have one last question, personal question. I'm sure a lot of people in this room have had family experience with this, but maybe if you could comment on your slide, you talk about pushing healthcare to the most cost-efficient level of provider. And one of the areas that astounds me is Medicaid coverage of assisted living. With hardly any states have that. I think in New Jersey maybe there's a couple of homes.
And people that qualify for Medicaid then get pushed to nursing homes. So instead of paying $3,600 to $4,800, you're paying $9,000 to $12,000. In the states that you deal with, are you getting any sense that there's movement afoot to allow for Medicaid coverage of assisted living, or is the nursing home? What's behind? Is the nursing home lobby saying we want to keep our flow of patients coming?
Yeah, I haven't really studied it, but I haven't heard anything about, assisted living's always been private pay and, a little nicer facilities and things like that. And I haven't heard anything about Medicaid paying for that. It should, I mean, if they can do it cheaper, then you don't want somebody in a nursing home that could be in an assisted living facility. You can get it cheaper.
Well, this concludes our spring session. We want to extend a very warm thank you to all.